Let's start right there. I mean, what should we be making of this rift, which is not common for us to hear aired out in public like this?
Well, and again, thanks for having me. I think you just nailed it on the head. It's not common, particularly when we think about the profound cooperation that the Treasury and the Federal Reserve applied, and quite successfully, I would argue, in the early days of this unfortunate COVID-19 situation. So it was, I was somewhat surprised by it. I think some of these facilities, although some of them were not heavily used, they were, certainly important in smoothing market functioning. So I think the pressing question going forward is, if we're in for a little bit of a choppy economic environment, what, if any, are these alternative assets? How are they alternatively applied, given the need for potential fiscal policy?
But Joe, the market reacted when they were introduced originally. That's when we saw the big reaction, the calming reaction. Once that is now out of the way and, once markets went back to sort of some kind of normal functioning, does it really matter about the confidence level here, in the sense that the market has corrected?
Well, I think there's cross currents right now, Vani, but I would still characterize it as positive. I mean, I think the just a non-negotiable positive and clear positive is just the news we've had with respect to the vaccine and its efficacy. I mean, that certainly was even above our highest expectations. Now I think it is a matter of policy, and in the markets, a reflection of that, of buying time where needed for the vaccine to be distributed. And so whether that's some form of fiscal policy, as well as continued focus of the Federal Reserve at the margins in the months to come, because we're going to see a sharp downturn in growth for a brief period. And so it's how you soften that blow until a vaccine can be distributed.